Premiumization, the end of affordable luxury watches. The Apple Watch that's killing the regular watch market. Are we doomed to a world where the only watches we can get cost $10 or $15 or $20,000? Is there any hope for those of us that just want a good $3,000, $1,000 or even $500 watch? You likely know the numbers. The overall watch market has been in decline in terms of volumes for more than 15 years. Watchmakers are still making money because they've raised prices. Today, you need to spend $8,000 to get an Omega Speedmaster. There was a time where you could get it for less than half that. And the difference isn't just down to inflation. So today, we're going to walk through what has been happening in terms of the overarching trends of the watch industry and consumer behavior. Why has this been happening? Will it continue? And how have watch manufacturers adapted to these trends? Finally, we'll answer the question, what is the result for us watch enthusiasts? Let's dive in. Are there going to be any watches left worth buying? I'm ignoring the current downturn in the market, this slump that is basically a burst bubble that was the post-COVID hype. I'm ignoring it because the watch market in general will, like all other industries, have upticks and downturns in the short term. Even things on a general downward trajectory can sometimes go up and vice versa. What I'm more interested in is the longer term trend, and that trend hasn't necessarily been great. Actually, it's been terrible in terms of volumes. In 2011, Swiss watchmakers exported a massive 29.8 million watches to the rest of the world. In 2020, that number had dropped to less than half, with only 13.8 million watches exported. That's a massive decline. Underlying that number, the main decline has been for quartz watches. In 2011, quartz watches made up almost 80% of Swiss watch exports. In 2020, that ratio had dropped to 60%. In that time period, it was by far quartz that was taking the biggest hit. Fast forward to 2023, and there was an uptick because of COVID, both for mechanical and for quartz watches. Quartz was massively driven by the Moonswatch from Swatch, but the numbers are still, in terms of volume, far below 2011 and even below the previous high of 2019. Beneath this overall trend is the fact that a lot of watchmakers are actually making more money on the bottom line than they ever did before. How have they been doing that? Well, in 2017, 7.3 million mechanical watches generated an estimated 15 billion Swiss francs of revenue. 6 years later, those 6 million watches now were generating almost 21 billion in revenue. They've just literally sold more expensive watches. Customers have either chosen to buy more expensive models, or the models on offer have just become more expensive in themselves. Either way, the margins are much higher, and despite selling far fewer watches as an industry, the industry as a whole is overall doing okay. Some brands, those under $4,000, and especially those under $1,500, are not doing well though as a segment. There are a lot of different ways of categorizing watches by their price point, but basically anything below premium has been under pressure. Unsurprisingly, this is also why Swatch Group have been having a hard time. Swatch Group is a broad spectrum conglomerate with a lot of sub 4K brands in their portfolio. That, and they've been really quite skilled at mismanaging brands like Blancpain and Breguet. So overall, Swatch has been impacted quite significantly as a group. The brands that have been most under pressure are the ones like Longines, that in 2019 produced over 2.1 million watches and now produce less than 1.5 million. Swatch, up until the Moonwatch, were on a massively declining trajectory. Tissot, Hamilton, and a lot of others have been feeling the pressure, where brands like Rolex, Audemars Piguet, Hublot, they've all increased not only their revenue per watch, but also their volumes. Generally, the combination of being independent and high-end have been a recipe for success in recent years. Why the decline? There's more than one reason, but the biggest one is likely the Apple Watch, the iPhone, Garmin, and priorities. In the last 15 years, you have not needed a watch anymore. Your phone could tell time. The Apple Watch, in theory, at least can do so much more, although I do contend that 90% of users use 10% of the functionality, but that's beside the point. Since the advent of the Apple Watch and its competitors, the sale of those kinds of watches have completely and utterly eclipsed the sales of regular watches, quartz, mechanical, both of them. Last year, the estimates put the total number of units of wearables sold at 186 million compared to 5.2 million mechanical Swiss watches. It's also because of the decline of status in a way. If you on young YouTube and follow any famous YouTuber, there's a chance that they've flashed some blinged out watch, a custom non-factory set day date, a Richard meal, or they've gifted their friends with Hublots. High-end watches are still a flex in a lot of circles, but watches in the broader public don't communicate status in quite the same way that they used to. I could refer you to a Deloitte report from 2023 that covers this topic, but I'll rather share a personal anecdote that kind of illustrates the general trend. For 11 years, I worked in a consulting firm. And when I joined, most equity partners celebrated their promotion to partner with a watch. The watch was mostly a Rolex. Sometimes it was an IWC, sometimes a JLC, rarely anything else. As the company I was with upped their prices and they started to make more bank, things started to change. Things kind of went in two directions. There was a small group of senior partners that drifted away from Rolex and instead gravitated towards Vacheron and Patek and AP, the real true high end. And the other partners, they got smartwatches and activity trackers instead. Today, more and more senior partners, consultants, and also C-suite executives that I meet wear smartwatches and sport watches or nothing at all. I've been around my fair share of current and future C-suiters who choose not to spend their money on an expensive watch, but instead on a $10 or $20 or even $30,000 road bike with carbon fiber and digital brake shifters and the whole shebang. Now, sure, I still see people who do both, and I definitely meet the corporate finance bros today that have their heavy hitters. But to a lot of those professionals that used to splurge on a Submariner, that money is going into other ways of flexing. It's the triathlon bike, it's the paddle board, and it's all that Superman gear that CXOs use to broadcast who and what they are. Now, bear in mind, I'm not reducing all watch buyers to management consultants, but Deloitte does point to this trend from a 2023 report. In the West, at least, there's this trend that a lot of people don't rely to the same extent on their watch to signal something about their values, their status, or their interests. It's not so much about owning a smartwatch, it's about communicating that you're active or signaling some other virtue, and a Garmin signals being active or outdoorsy. A Rolex might not send that signal. If you want to signal that you're technical, a Casio F91 might signal that a whole lot better than a Flexi Patek Philippe. For every tech bro who's into crypto, there's also the Zuckerbergs and the Steve Jobses who just wear plain white t-shirts and no watch at all. And that's how they communicate their personalities. And a lot more people are communicating their personalities and status in a lot of different ways and non-standard ways, in the ways which were more common previously. For both these reasons, so smartwatches and the changing ways of communicating status and personality, watches have been suffering. You and I know about Hamilton and how their khaki watches are super cool, but for some random Joe who just wants something to track his runs and go hiking with, an Apple Watch costs about the same. So why not buy that? The practicality of a watch has been supplanted by the phone. You don't even have to have a smartwatch to tell the time. And it's not just on Hamilton. The effect is similar on Rolex and Omega too. Rolex has succeeded in growing on every single metric according to industry experts, but they too have had to work hard to make their watches even more exclusive. Whether we like it or not, a date just isn't as impressive in a lot of circles as it was 10 or 20 years ago. I might even go so far as to say that the flex is sometimes being able to either have the money to pay above retail for a Daytona, or have such a vast purchase history with the AD that your wait time is under 6 months. The Rolex in and of itself isn't as objectively impressive in quotation marks as it was years back. Just in general, how you impress people and what it takes to impress people has changed a lot in the West and also to some extent in Asia and the Middle East. Will it continue? Yes and no. The most pressing question is about smartwatches. And in short, smartwatches are not going to continue growing at the pace that they have. And smartwatches won't replace all watches. Any market for anything is basically just a pie. Estimating the size of that pie is always difficult. It's some function of the number of people in the world that can afford your product and can be convinced that they need or want your product. Whenever a new product comes along, That market is untapped and growth is massive. It's just a race for new players to get people to buy your product. Growth is rapid and it feels almost exponential. As the pie gets filled up with people that own the product, the dynamic changes. From then on, it's about convincing people to switch to another watch or upgrade or renew. So with the iPhone, growth was massive as people ditched their Nokia or their Motorola for a smartphone. Smartphones aren't as huge a growth market as they have been. There are huge untapped pies in Africa and other markets, but largely smartphones are everywhere by now. Once something's everywhere, another thing tends to happen, especially with technology. People replace their products with ever decreasing frequency. I mean, think about it. From the first iPhone to the fifth iPhone, how often did you upgrade? I think I upgraded pretty much every year. And now I'm probably upgrading once every 4 or 5 years. As the technology matures, the replacement rate drops. The same thing is already starting to happen in smartwatches. In mature markets, so the West, people who want a smartwatch have one, and the time between getting a new one is increasing. That period of exponential growth is largely coming to an end. There's no data that supports an argument that every single person on the planet wants a smartwatch. And there's no data that supports an argument that every person that wants a $1,000 timekeeping device will always choose a smartwatch over a mechanical or a quartz watch. This is not a case of the car replacing the horse-drawn cart. The smartwatch pie does have overlaps with the watch pie, especially in the low end, but it's not the same pie. Smartwatches functionally can do everything a normal watch can do, better even. But we have to remind ourselves that whether it's a $200 or $2,000 or a $200,000 watch, that watch is not just being bought because of the functionality. Aesthetic, lifestyle, signaling, call it whatever you want. Watches are an accessory that also communicates something, and they communicate something different from a smartwatch. As long as a brand can continue to communicate something, anything that someone can identify with, then people will buy it. But for sure, it's not going to get easier being a producer of $500 or $1,000 watches. To me, the massive decline in quartz makes sense. Quartz, bar a couple of FP Journes here and there, is generally not associated with luxury in the way that mechanical watches are. So quartz, I think, is largely seen for a lot of people as practical. If all you want is practical, then the Apple Watch is going to be a satisfactory replacement. How have the brands adapted? Premiumization. You know the story. Premiumization is all about raising prices and increasing the perceived value of your product. Charging a higher price for largely the same product by convincing people that this specific product is a luxury, it's desirable, and not necessarily readily available. Patek did this by discontinuing the steel 5711 and essentially forcing all new customers to start their Patek journey by buying entry full gold Calatrava variants. Lange & Söhne have just stopped publishing their prices for their watches. Jaeger-LeCoultre, well, they took the exact same products and added 30 or 40% to the price overnight. Now, whether Rolex did it on purpose or not, the shortage of steel Rolexes has definitely driven more people into two-tone and full gold models. Tudor's also done this. With every new release, there has been a feature that worked as a justification to raise the price a teeny tiny bit. A better bracelet, a new size, a Jubilee bracelet, a new material, and most recently Metas. Make no mistake, Metas has never been about better quality or accuracy. The Metas movement is the exact same movement that was in the previous Black Bay, but you pay more for the privilege of that certification. Now, I used Patek and Lange as examples, even though they're not usually how the premiumization term is applied. Premiumization is applied mostly to those $1,000 watches from Seiko that now cost $1,500, or the Seiko limited editions that now easily cost $5,000 or $6,000. So the SJE 093s of this world that are literally the premium Seikos. The reason I choose to use the term a little bit more liberally is because everybody, regardless of segment, have been trying to climb up the ladder. If you think of those Apple Watches as a flood, then the brands are all on different rungs of the same ladder, and they're all trying to get to higher ground. It's kind of inevitable, really. But how can they think that this will work? Well, part of it's based on, at least I think, three things as I see it. It's a profit logic, a fear logic, and a little bit of self-delusion. The profit logic is the most straightforward one. A Rolex Submariner's price in gold is roughly $30,000, more expensive than the steel version. 18 karat gold has a market price of less than $2,000. I'm keeping it broad. Those in the details can let me know the precise price in the comments. But everything else in the watch is fundamentally the same. It's got the same movement, it's got the same case, it's got the same features. And gold is actually typically easier and cheaper to work with than steel because it's softer. So the gap from $2,000 for the gold to $30,000 for the sale price is pure profit. So if I do some 4 pints of Guinness kinds of math, you can basically lose 15 steel Submariner customers and still make the same profit if you just sell one more gold Submariner. The same goes for Jaeger Ultra. You lose a couple of customers that don't want to pay 10K for a Reverso, but some will. And the hope is that that will offset the drop in volume. That's reasonably solid profit logic. The fear logic isn't unjustified. If you are Longines and your average sale price of a watch, according to Morgan Stanley, is 1,000 Swiss francs, and Hamilton and Tissot and others start raising prices and improving their product, what happens if you do nothing? Well, your brand starts to seem less valuable to customers. To maintain the impression that you are a couple of rungs above Tissot, you need to offer more and raise prices. For Longines and Tissot, that are both part of the Swatch Group, that's likely a coordinated effort, but the mechanism is there and it hits Zinn and Nomos and Seiko and all the others. If you don't move up, you are essentially risking devaluing your brand. So you have to climb that ladder whether you want to or not to maintain your position. You don't want to get your feet caught in the raging floodwaters. And then there's delusion. Another personal anecdote on my part. Do you know what the difference is between a C-suite and a regular employee? The regular employee will, in an unguarded moment, say, our product sucks compared to our competitors. The C-suite will say, we have an impeccable heritage, and the management consultant's analysis shows us that with a focused strategy, we can differentiate ourselves further from competitors by doing A, B, and C. That's like super sarcastic on my side, but the reality is the products aren't always as amazing as executives sometimes convince themselves that they are. My personal favorite example is Jaeger Ultra. At $5,000, which was the price for a Reverso a couple of years back, your option at 5K was more or less a Reverso or an IWC Pilot or even a good Omega. Now, at closer to 8K for the absolute entry manual wind monoface Reverso, you are now $2,000 more expensive than an IWC Pilot. At a bare minimum, for some period of time, you really need to work hard to convince people that you're suddenly worth that much more. Consider also the Master Ultra Thin Small Seconds in gold. It used to cost about 15K. Now it's 20K. A Lange Saxonia is only 3K more. Raising the price alone is not going to convince a buyer that a JLC, which is a good watch, can compete with a Lange. 8K is a huge difference. 3K is less so when you're already above 20,000. To be clear, I'm not passing personal judgment on whether Lange is better or worse than JLC, but the fact is the price gap between JLC and Lange has been narrowed on some models, and that invites stronger comparison. As a company, you need to be dead damn sure your product and your brand perception can stand up to that comparison. The element that I feel is delusion, and it is a feeling, is that so many brands think that they have a strong enough product to become that much more exclusive. I've always kind of liked the quote, if everything's exclusive, then nothing's exclusive. The point is, there's only room for so many Richard Milles and Pateks and Vacherons. It's the pie discussion again. The overall market for mechanical watches is not really growing outside of some emerging markets like China and India. China's a nightmare right now, but China and India still have huge potential. But at the end of the day, the market is kind of fixed. So JLC going upscale and distancing themselves from the likes of IWC just puts them up for more of a comparison with Lange, Patek or Vacheron. So before they were fighting for pie pieces with IWC, and now they're just fighting for pie pieces with some other even more expensive brands. That's not exactly an easier place to compete. The same basically goes for Rolex. An anniversary Le Mans Daytona is hyper desirable, but generally when you step into a room with heavy hitter sheiks and multi-billionaires, that Le Mans is likely one of 3 or 4 Rolexes that have the flex power to impress them. These are people that get piece unique Pateks and custom Richard Milles and buy their business associates Moser Streamliners as Christmas presents. In the eyes of some Patek aficionados, even the 1908 in platinum is positively pedestrian in terms of build quality and finishing. So many brands want to attain this increased level of exclusivity and desirability, but I do honestly believe there's a limit. There are fewer customers and the competition is massive. Not all of them will succeed, and some of them will end up just being more expensive with not much more to show for it because the product hasn't changed. Overall, though, you can see that the adaptations that the companies have made have tended to follow similar playbooks. In the high end, so Patek and all the others, they've essentially limited supply by raising prices and by prioritizing long-term customers. They've also reduced their distribution network and just generally have a very limited nature. Just below the high-end, Rolex and others like them have been leaning heavily into precious metals. Even Omega have started doing this. Omega has always had two-tone and full gold watches, but this year the Speedmaster, as a good example, changed. Now, for the first time, Omega has a Speedmaster lineup that almost perfectly mirrors the Daytona lineup. So in steel, you have a black and a white and a Hesalite. Then you have a couple of two-tone models, and finally you have multiple variants in precious metals. This year and last year, JLC prioritized complications when it came to new releases. Lacquered dials, perpetual calendars, and duometre specialties have been the flavor of the day. Same goes to some extent for IWC with their eternal calendar and 168-hour Portugueses. In the mid-range, Tudor has led the way with upgraded bracelets, Metas, Jubilee bracelets, thinner cases, and specialty materials in models like the FXD. If you've followed Longines for a longer time, you'll know that they too have upgraded in terms of finishing, dial complexity, and movement specifications. Back to that Morgan Stanley report, and I have to repeat this point. They estimate that the average Longines gets sold at about 1,000 Swiss francs. The Longines Spirit is closer to double that. The Zulu Times, the Hydro Conquest GMTs, the Magitex, these are the watches we love, and they are functionally the high-end models for Longines. Those are the watches we fall for, but their bread and butter has historically been a lot cheaper. And at the lower end, well, the Tissot PRX. Sure, you could get the quartz model, but for not much more, they offered the mechanical Powermatic AC version. More importantly, Tissot, Hamilton, and all the others have not necessarily been cutting down on the overall catalog size, but they have definitely focused their energy on flagship models. It's the Khaki Expedition, it's the PRX, it's the Cetina DS. It's only Seiko and Citizen that just consistently seem to just throw out what feels like millions of new options every year. For the Swiss, focus and cutting back have been the name of the game. This brings us to the big question. What will this mean for us as watch consumers? Price increases are a given, but that's not particularly insightful. The key question is the sub $4,000 and sub $1,000 space. Is it going to become so unattractive that brands like Tissot, Hamilton, Nomos, and others just disappear or give up? Spoiler? No, I don't think so. Remember early in the video, I talked about the pie, and I said the watch market and the smartwatch market overlap, but they are not the same pie. I also said that all watchmakers are trying to climb up the ladder to avoid that flood that they fear so much. But here's the thing. We're already seeing the future. What has happened in the last 10 to 15 years, especially in the last 3 or 4 or 5 years? There's Anordain, a Scottish brand that entirely focuses on enameling, something that you usually only see with the Jaeger Ultra and the high end. They're doing fabulous work for less than $6,000. Furlan Mari has gone full on vintage, just like Baltic, but in a more premium price range with offerings that, with a I don't know how to say peso movement, inside could easily rival offerings from Hamilton or Longines or others. Zelos, Formex, in the high-end Akrivia, Akrivia is a good one, Brescia Prescepi, former Patek Philippe apprentice. Did he go conglomerate or did he go independent? He went independent and is reaping the benefits. My perspective is not that the watch industry for affordable watches under 4K is dying. I do believe firmly that the established watch industry for affordable watches is dying. I think being Longines or Tag Heuer or JLC as part of LVMH or Richemont or Swatch Group is incredibly tough. The industry consolidated massively a lot of years back, but who are the winners in the high end right now? It's the independents. It's AP, it's Patek, it's Rolex, it's Richard Mille. Who are succeeding below 4K? It's brands like Christopher Ward. I just use Christopher Ward because they're so hyped right now. So it's a good point of reference for a lot of people. It's not that I necessarily think they are head and shoulders better than so many other independents. But it's the independents, the micro brands, the startups. They have a couple of things that those established brands don't have. They are more nimble, in part because they are often not fully in-house. They buy their movements from Celita, they get their bracelets from Dexel, they get their dials from somewhere in China. They don't have a huge cost base that costs money up front. They also have a lot more of a flexible distribution network. They're often online only and they don't deal with middlemen and ADs that want a cut of the profits. They're also not bloated with too many products. They are typically incessantly focused on producing a focused lineup of watches that sell. There's no filler in their display case, and if it doesn't move, it gets cut. They have all those advantages that some of the conglomerates don't have. And most importantly, more than anything, they are customer and product focused. They aren't managed through PowerPoints and strategy white papers. They try to design something that people like, and they engage with customers in a very different way. Now, sure, the quality control on a Christopher Ward has been questionable as of late because their volumes have increased, and I think that's giving them a little bit of a challenge. But generally, they do a good job. Zelos is sold out far too quickly, and Anordain has the most bananas waiting list for a sub $6,000 watch. But they are stealing pieces of pie left and right from the bigger players. And I haven't even gotten to the Chinese brands yet. For the most part, those Chinese brands are predominantly replica brands still, but quality keeps increasing every day. And if they can hit a vibe in terms of design, I do believe more people will be perfectly happy to pay $500 for an original design from a Chinese brand at some point. The 80s and the quartz crisis led to a lot of brands dying. Other brands repositioned or strengthened their position as luxury products. They distanced themselves from those cheap quartz watches. That's going to happen again, and it already is. What's different though is I don't see that 80s and 90s consolidation happening. The future is not conglomerates, but rather independents, especially in that sub 4K space, because the agility and flexibility needed to survive is going to be critical. For me, the end state in the sub $4,000 and sub $1,000 space is not an inevitable decline. Rather, I think the end state is going to be a paradox of sorts. In 10 years' time, I think there are likely going to be fewer in total volumes of those watches sold, but overall variety, I think, is going to be higher in terms of watches and brands. As enthusiasts, I do think we'll have far more options. I do think there'll be a lot of Celita and NH34 skinned watches out there, but there are going to be so many options. We might not see Tissot and Hamilton in the display cases at Booker in 10 years' time. But online, I do think this decline is going to make space for so many more options. And yes, some of those independents are going to die. Not all of them will be able to sustain their popularity. Brands like Christopher Ward have had decades without a profit in basically the hope of gaining a volume level that can cover their costs. But some will succeed, and I do think the key to remaining successful is not going to be about consolidation, but rather about being nimble and staying focused. So I don't think it's the end of the world for watches. I think we're going to have less big brands, and we are going to have a whole lot more variety, especially in that entry kind of space of $1,000 or $2,000 or $3,000 or $4,000 or even $500. That's what I think. It's a crystal ball. I don't know for a fact, but that's kind of where the numbers sort of take me. What do you think? Let me know in the comments. Like, subscribe. Cheers.